I kind of lost my focus. So, all right. So, good morning, everyone. I'd like to thank Chris Dunn for the very good presentation we had before. And well, today I'm going to present the part 2 of a small business exit plan. Last year, we went over what the different business exit strategies were, and we went through the pros and cons of each strategy, and we kind of at the end we kind of went over an estimation of our business value. We're going to go over that again this year, but in a little bit more detail. We will focus mainly on how to prepare an exit strategy. The exit plan we will focus on today is selling the business to a third party, which is the most popular exit strategy. You know, each year there's about 500,000 businesses that are sold in US, and so we're going to focus on that strategy. Okay, and I'll focus also on the seller's perspective. As in the membership, I kind of think that most of the members are more sellers than buyers. So most of the time I'll present the seller's perspective. This is a slide from last year, which explains what is a business strategy, and it's a plan for wrapping up your involvement in a business. It's today we're going to focus on how to get to that point, making the business ready for a sale. Also, part of the exit strategy is that once the business is sold, what are you going to do after? The goal is to leave the business in the best possible shape as possible. It means operating at peak profitability. The books should be spick and span, and again, the owner selling his business may and may not be involved after the sale. So it's part of the plan, whether you want to stay involved for how long and in what capacity. No matter what, I mean, you're going to exit your business no matter what happens. I mean, it's kind of a given, whether it's for health issues, whether you're getting to retirement age, whether it's a change of career, you are going to exit your strategy. So you might as well be prepared. And some part of the preparation is determining how and when you're going to exit, how much you'll get out of it, or will that be enough to secure your future? Also, why I'm presenting part 2 this year is because most business owners do not have an exit plan, and I was part of those guys. Years ago, as you may know, I owned numerous companies over the years, and I sold and bought companies. And at one point, it was around 2008, I got in a big slump in one company, and I was fortunate that my future was secure. My family's future was secure. I had enough money to pay the liabilities if I had to personally. So at least that was covered. But I was determined to exit that business successfully, and I didn't have a plan. So I went to search for investors. I went to try to sell the company, and didn't work out. So I decided that I'm going to do my homework, roll up my sleeves, and get to work and see if I can turn the business around and put it in a shape where it could be sold with a nice profit. It took 3 or 4 years to put everything together, and it did work out. So based on that, actually today's presentation is a little bit based on my own experience and how I managed to turn the company around and bring it to a shape where it could be sold. So those are, as I said before, those were the exit strategies we went over last year, and which are the main ones are passing the business to a family member, management or employee buyout, selling to a third party, which is the one we'll focus on today because it's the most popular, and most business owners want to sell their business with a profit after they had a lot of fun with it. A lifestyle company and liquidation. So in order to prepare, we need to kind of understand what investors are looking for. Put in a nutshell, investors are looking for low risk and high profits. So in order to have the company in shape for a possible sale for interesting investors, well, you have to look at your business from the perspective of a buyer. So low risk, high reward. Well, it translates into consistent sale over the years, consistent EBITDA, stable and a competent workforce, trained employee, stable and loyal customers. If you depend on one customer, well, you're not in good shape. So you have to, kind of, the goal is to have customers not weighing more than 15 to 20% of your business. It does not always happen, but that would be a goal to shoot for. Also, to investors are as they are allergic to risk, they will look at your potential future. Where will the growth come from? Do you have customers that are lined up for numerous years? Are they locked in contracts? And also, we will examine if your business work on defined process that kind of things are done automatically. So basically, that's what the investors are looking for. Now, there's two kind of business owners, and I was those who plan ahead and those who don't. I was on both sides, so hopefully you guys will understand that you have to prepare. If you're not, please do plan for an exit strategy, and it would be nice if you could exit on your terms. So now going forward, we're going to examine the different steps to consider as you prepare to sell your business. The first step is setting up your objectives. Are you going to, what's your exit strategy? As I said, today we'll focus on selling the business. When do you plan to exit? Are you approaching retirement time? When do you want to retire? How much is enough to secure your future? Do you count on the business to be the sole contributor to your future, to your retirement? If so, well, I mean, you have to prepare. You have to know how much you'll be getting. Do you want to be involved after the sale? Do you want your employees to be passed on to the new owner? What are you going to do after the sale? If you are involved in the company, in what capacity will you be involved? So those are things you need to consider in preparing for the journey towards the sale of the business. You have to prepare properly. That's not an easy process. It takes time. So allow enough time to get ready, to make things happen, to write down your plan and keep it up to date. Review the plan every year, every other year. Identify your value driver. What makes your company unique? Do you have intellectual property? Do you have a product that nobody else has? Are you in an area where you're a leader? Find what could stand in the way of a potential sale. Have a target figure for retirement. I mean, if let's say you retire at 65 and you're planning of having 20 years of enjoying your new life, and you think you'll need about $50,000 per year to enjoy. Well, I mean, 20 years multiplied by 50, that's $1 million. So at least it gives you a target if that's what you need. I'm not saying that's what you need, but it's an example. It's a very simple calculation, but getting there is not as simple. Determine the value of your business and be realistic about it. I recently worked with a catering company who they were doing $1.5 million turnover a year, and their EBITDA was around $100,000. And the owner projected that in 3 to 5 years they wanted to sell the business for $15 million. And their growth plan determined that they would grow 3 to 5 times during the same period of time. So was the business value, not the business value, but the goal to the target price for the business, was that realistic? I wouldn't think so. I mean, if you grow the business 5 times, 1.5 million multiplied by 5 is 7.5 million. So how can, especially in the service business, and the multiple was way too high to interest a buyer. Review your operations, commercial, human resources, financial process, review everything, and prepare as early as possible, as timing can be everything. Will you be ready when a buyer will knock on your door? So the sooner you are ready, the better off you could be. Get the business affairs in order. Smart buyers will ask for at least 2 to 3 years worth of clean and dependable financial. Make sure that you have clean financial. One of the we often see in small businesses that bookkeeping is kind of, it's not done professionally. There's anomalies that there's sometimes it's done many weeks late after the fact. So adopt the GAAP standards. Separate your personal and business financial. We'll address that a little later in the presentation. Keep track of personal expenses as part of your business operation. Maintain fiscal, legal, and commercial responsibility. Make sure you have sufficient cash to pay your off liabilities if it comes to that. So again, to attract investors, will show consistent EBITDA. The investors and company buyers, they're interested. They look at the top of the line, top line, and bottom line profitability. So balance growth and profitability. You maintain EBITDA growth for at least 3 successive years. Avoid wild revenue swings. If you do have swings, you have to explain them. And consistent growth in profits translate into a reduced risk for the buyer. And remember that everything you do to improve your EBITDA, it will be worth X time when you come to sell the company. Articulate and demonstrate a growth plan. Again, buyers will be attracted if there are opportunities for future growth. Where will the growth come from? Will it be from different channels, different new products, new channels, new customers? You have to demonstrate and implement the opportunities. I read a study a few months back that 65% of the sales projection never happened, and that was a study based on a few thousand businesses around the USA. So you have to show, you have to prove that where the growth will come from. So implement the opportunities so the buyer can believe them. Find the strength in your business and grow them. What makes you different? What makes you unique? So similarly, figure out the biggest holdbacks and fix them. Again, I want to stress that the investors, they want high return on investment and low risk. And I'm sure you guys who went to a bank to get some funding, they're probably, you got a sense that what they're looking for. Execute well-defined client contract. I know that's not always easy to lock in customers into long-term contracts, but as much as possible, do it as your investors, your potential buyer will look into that, and it's a proof that they can the business can sustain growth over the years. So you want to show you want also to show that your source of revenue will be stable over the coming years. Be sure that the contracts are transferable. The buyer will be interested in that part of the contract if you can lock in some customers into long-term contracts. Demonstrate solid sales and marketing. I seldom encounter small companies with marketing plans. I had a partner years ago who used to say, "No sales, no business," and he's right. He was right. In small business, usually in small businesses, the owner is the biggest sales producer. So in order to interest an investor, if you're gone, how will the sales be generated? Do you have on your staff people that are knowledgeable in marketing? Do you have trained salespeople? Do you have a sales department that work on its own? How do you generate new leads? Do you have a process to generate lead, to generate sale that doesn't depend on the owner? As part of your marketing plan, do you have an updated website? Would you consider digital marketing? I mean, it's the way to go nowadays. Networking events, social media, whatever you can do to grow your sales and to grow your profits. Well, I mean, you have to consider that. To ensure a bright future for your business, you need a sales machine that can function on its own and to generate predictable revenue streams. So if you don't have staff, well, consider outsourcing sales support, marketing, and sorry. As in sales, often, the owner is the decision maker. He controls everything. He has his hands in every aspect of the business. But what if you're hit by a truck and you can't come to work for an extended period of time? What happens to the business? Will it function without you? So you have to eliminate the dependency on yourself. If the business can't function without you, well, it has no value to a potential buyer. Make your business process dependent and not people dependent. That's an issue we see in most most businesses. All the function are dependent on people. If that person is gone, what happens? But if you have a nice process, chartered process in place, well, you can replace the person more easily, and nothing stops in the operation, and you move forward. document and standardize the process. It's kind of like your FISMA and the SQF documentation, where you define processes, you define the course of action, and you record everything. You have workflows, you know, to make things optimal. Train your team to ensure that they execute the process consistently. Lock in key employees with good contracts, include non-solicitation and non-compete if you can, and make sure that those contracts are transferable to a new owner. Implement systems that assure reliable performance. Who does what, when it's done, and how is it done, how it's recorded, how do we make sure that things are done, who's in charge, who's in control of those specific tasks. Prepare protocol to guide all this. Write a how-to manual so that a stranger could pick up the reins and run everything. You have to make it easy for the business to be transferred to a new owner. If that doesn't happen, well, it's, you know, the owner, the purchaser will, you know, it's a red flag for him. If he has months and months and months of preparation to take over the business, well, he might not be very interested, or you might be not willing to pay what you're expecting. Record every process, including administration, and note the steps to be followed for every task. Write formal job description for each employee. Create templates for tasks that are repeated. So the goal is to make things happen automatically in the business. Prepare an elevator pitch. An elevator pitch is a speech to trigger immediate interest for a project, for a purchase, for a new product. Craft a storybook for your business. Indicate why you got started. Explain how you've grown. Describe what has been achieved. Well, paint a positive picture of the future, but keep it real. Incorporate a few stats and facts to support your pitch. The goal is to excite a potential buyer and create a huge interest so that, you know, it jumps into the negotiation. So based on the previous slides, I've prepared kind of a checklist for pre-sale improvement. I've covered a few, but you can add on whatever you think you need to do. The business aspect I've covered are legal conditions, and for every aspect you check whether you're on par, you're below par, you're nothing is done. So you assess your different aspect, and so you focus on those you need to improve. And I've listed some of the aspects an investor will most likely examine and check if you're in good standing. Clear ownership of assets, long-term transferable leases, liens, claims, encumbrance, pending litigation, labor issues, license, zoning issue if you have a property, financial, are your revenue increasing, the profits increasing, Is there any revenue swings? Positive cash flow? Are the tax paid on time? Current debt payment? Current receivables? Are your receivables outdated? Do you collect on time? Are your financials clean? Are they complete? Are they reliable? Are they made on with the professional standards? Business operation and organization. How's your bottling equipment? In good shape? Does it need improvement? Are they outdated? Are there some major pieces missing? Establish and train staff. How's your staff? Trained? Do you have a high turnover? Do you have systems in place? Do you have a business model? What's your business model? Is it different than others? Would that business model allow you to grow? Or does it lock you into a situation where, you cannot go any further? Key employees with transferable contracts, sales and marketing plan. If you don't have one, well, create one. Your clients, have they been with you for a while? Will they stay with you for quite a few more years? Are they under contract? Are those contracts transferable? Do you have one major customer on which you depend for most of your sales? Are each customer profitable? Do you have products that are not profitable? So the list can go on and on and on, and so I just highlighted a few of the aspect a potential purchaser would focus on, would check whether you're on par or not. Raising money is not easy, but selling a business is not only selling assets or goodwill. Selling a business is selling years and years of hard work, of tears, of setbacks, of painful moment. It's selling also, joy. It's reward. It's selling a fulfillment. It's selling. So you have to make it work for yourself. So sometimes it's a second generation or third generation business, and you have to somehow prepare to get rewarded for all the hard work that you've put in over the years. So the business valuation represents your company's total worth. Business advisor will use numerous formulas to approach what your business. You determine for yourself what your goal is, how much your money you want, and you can, if you to be on the safe side, you could get an advisor, whether it's an accountant or a business appraiser, to calculate, to help you determine what how your business is valued. They will use numerous formulas. Some are asset-based, though others are based on income. For most small businesses, the valuation method that is preferred is the EBITDA. It's a multiple of EBITDA. For small business, usually EBITDA is generally used for larger companies, and for smaller companies, it's the SDE, the seller's discretionary earnings formula, that is, which is a measure of how much money a business brings in for the owner, regardless of who that owner is. The multiple, usually the valuation is a multiple of EBITDA or SDE, and the multiple will vary on industry, market condition, the shape of your business, the eagerness of the buyer to sell, to purchase your business, and numerous factors on goodwill, asset, risk. So how is SDE calculated? Well, it's a formula based on earnings. So it's your net earnings before tax plus non-recurring expenses minus non-recurring income plus non-operating expenses minus non-operating income plus depreciation plus amortization plus the interest expenses plus the owner's total draw. Well, there's potential for debate between the buyer and the seller on some of those aspects. Especially, total draw and non-recurring expenses. Owners tend to transfer some of their personal expenses into their business operating expenses, which, I mean, that's legal and it's legitimate, and most people do it. What that does is that it reduces the net profit and the company net profit and the company income tax. And owners do that year after year and after year, and it's a pretty nice benefit for them. But that being said, is that also it could potentially also reduce the valuation of your company if all the expenses, the personal expenses, the non-operating expenses, the recurring expenses, and the owner's total draw cannot be proven. And most often, to prove it, well, I mean, you shoot yourself in the foot you could possibly shoot yourself in the foot with the IRS. So be aware of that. Record your personal expenses, record all the expenses, all the events that are charged back to the company, so that it doesn't create a bottleneck during the negotiation. So be aware of that, and sometimes you may have a choice to make, whether you pay a little more tax and you have a higher value, but if you can prove everything, well, then, I mean, the business valuation should not suffer from it. Okay. What's your possible business worth? What's your possible business valuation, or what a buyer could possibly pay for your bottled water business? we went over what that's a mistake. It's SDE. It's not SED. It should be anyway, or EBITDA. EBITDA or SDE. It's an expression of how much money is earned by is brought in for the owner in a particular year. So the multiple is the multiple is used to take into account the growth over the years. So that explains the multiplier. So it's to spread the profit over a period of time. In our business world, in bottled water or packaging, it's a little bit the same. Purchaser tend to value companies at 3 to 5 times SDE, and that translates generally into 70 to 100% of annual sales. Sometimes they'll pick a particular year, and sometimes they will average out 3, 4, 5 years of SDE or annual sales. The ratios are indicative, and it's based on my personal experience, and it's based on a few deals that I've been made aware of, and but you'll never know what your business is worth till it's sold. So the last part I'd like to cover is that once you've interested a buyer, what happens next? I mean, there's a lot of terms you need to agree upon. And I've listed here some. The list is far from being exhaustive, but those are, in my view, the main one. You have to agree on a purchase price. I mean, if you don't agree to the purchase price, well, I mean, everything else will never happen. Whether it's an asset or a stock sale. I saw a figure that 75% of businesses are stock sale rather than asset sales. Some buyers are inclined to prefer asset sales, while sellers are more inclined to go to a stock sale. Is the purchase price will be paid in full at closing? Will the seller get a partial payment at closing and get a consulting agreement for a certain period of time? Will there be a partial payment at closing plus an earn-out where the seller earns bonuses based on future performance of the business? The buyer will, the buyer as well as the seller, they will share the profit if they can make the company grow, which is the target of the whole thing, as well as the risk. Will you and your employee continue to be employed after the transaction? If you are employed, in what capacity and for how long? What will be your compensation? Most terms will include for the seller a non-compete, and for key employee as well, non-compete and non-solicitation terms related to any seller-owned property, which are not part of the purchase price, right? Like a building, a plant, a real estate, springs, that is used by the business. Usually that's on top of the purchase price. What representation and warranties the seller may have to provide. Basically, that concludes my presentation today. It was short, but I like to think that it was to the point, and now I'm open to some questions. Hello? Anybody there?
Yep. Oh. Rouillard, thank you so much. That was an excellent presentation, providing us more insight in what to do as business owners. Let's see if we have any questions written in. We have one comment that says, in good times, companies sell for multiples of sales. Do you have any idea what the average has been in 2020?
Yes, I do have an idea. It's more like four times EBITDA. I suppose the question was about water-related companies. If that was the case, my answer was around 4 times EBITDA. Did you get that?
Yes, I would assume that that's also what that is who was asking.
Mm-hmm.
Are there any other questions? You can feel free to unmute yourself or raise your hand and I will see that and we can help you unmute or type in the chat or Q&A boxes. How does goodwill affect a sale?
Well, in a stock sale, most of the value is goodwill, plus some assets, but most of the valuation comes from goodwill.
The next question that's come in is how bad is COVID affecting the sale of business?
Well, what happened in the last few months is that, I mean, with the restriction on traveling and in-person meeting, buyers are not too inclined. I mean, if they can't, especially in our business industry, it's a face-to-face meeting not being allowed or being restricted. Most of the what I'm aware of, most of the transactions were postponed to a later stage, and it's kind of picking up at this time. They were kind of on hold for 4 to 6 months, and then, it's picking up at this time. We're seeing more activity.
Jeff, I just gave you permission to unmute. I believe you raised your hand to ask a question.
Yes, can you hear me now?
Yes, go ahead.
Okay, Rouillard, somebody had asked the question that how many times sales companies are going for right now, and you answered it in EBITDA, 4 times EBITDA, which is correct. What are you seeing in the, based on like somebody's actual sales? It's been what I've seen is around 1 time sales, but what are you seeing?
I'm seeing exactly the same thing. I mean, typically in our industry, it's I've shown on my slide between 70% and 100%
Yeah.
of sales, but but you know, the average, I would say, is, and that goes back, I mean, for the last, let's say average over the last 5 years would be between 70% to at the most 1.2, 120% of sales, 1.2 times sales. That would be the most that could be expected if everything was in proper,
generally
good
that's,
condition. You know, everything lined up, all, you know, long-term contracts, all conditions being optimized. I would say 1.2 times sales would be the max.
Would be the max, and that's generally for higher revenue companies anyways.
Absolutely.
Yeah.
And also, I mean, I don't know if I made it clear during my presentation, but I mean, the business valuation is based on multiple, let's say 4 times EBITDA. But that, I mean, from that, you have to deduct all the liabilities, the debt and the company liabilities. I had the question last year, and I don't think it was stressed. It was my answer was clear enough, but although it was shown on my slide, I didn't pinpoint that. And you know, sellers must be aware that liabilities, all their debts and liability will reduce what they can get for their business.
Thank you for that very helpful information. I'm not seeing any additional questions popping up. Does anybody have anything else additional?